Rahul Singh is here to discuss his market view and of course investment strategy from Tata Mutual Fund. Rahul, good afternoon. Thank you so much for your time. How are you looking at the entire this leisure, travel, hotel industry, which was crunched on business for last 6 quarters now, 1.5 years? Some commentary seem to be suggesting that they are readying for improved time if there is indeed gradual opening. We saw Maharashtra cabinet may take up gradual phased opening tomorrow. Some other states are also talking about it. Market is a forward-looking animal, so it will start factoring it ahead. What are your thoughts on some of the recent listings which are they feed into the leisure sector, hotel, hospitality, all of that, and platform companies? What are your thoughts on that pocket?
Yeah, I think you're right that a lot of them are deep recovery plays. So obviously there is excitement around what could happen if the second wave decline, which seems to be as steep as the increase which happened in the second wave. What it does to their businesses and the recovery. I think there are one or two words of caution I would like to urge here. One is that the first wave and second wave are quite different in the sense that when the first wave subsided, I think the general perception was that the second wave will be much smaller and much weaker, if at all. Now, this time, I think there is going to be a lingering fear, even when second wave subsides, of further waves, further mutations. Things have changed. We are seeing a lot of different variants of viruses cropping up in different parts of the world. So our sense is that some of the recovery plays will remain challenged for a longer period of time than what we assumed when they were coming out of the first wave of COVID. And also, let's not forget that the habits have changed for longer period of now. I mean, the first wave was 6-8 months kind of lockdown and partial lockdown. This is kind of extended that period. So therefore, habits in terms of going out, either food ordering or OTT kind of viewership, those things have to be seen as to what long-term changes in behavior it brings for the consumer. So therefore, one thing I would say is that there are some things which are irreplaceable, like travel or business travel in a longer period of time. But whether multiplexes or whether whether that can be replaced with something else, something more digital. I think those are the questions hard questions which one needs to ask before totally biting into these recovery plays which you mentioned.
Point. In fact, one needs to be very careful about the areas you're getting. There's a complete buffet out there. You have to choose very carefully. Let's shift focus and also get your thoughts on global cyclicals which went through a very reasonable amount of correction on a slew of issues coming in. Of course, numbers started improving, so there was some profit taking. Globally also, China started curbing on pricing. Do you think that entire cycle has still more juice on the upside? Some believe that the early money is made there. Others believe that it's a multi-year cycle, and as numbers keep on improving and debt keeps on decreasing, even if steel prices internationally don't rise a whole lot, the valuation of the business will start improving because debt reduction is happening and debt is transferring to equity in valuation terms.
Right. So there are two parts to that answer. First is obviously fundamentals, like you mentioned, in metals, how they've improved and so on. Similarly, I would say in cyclicals, even banks come under cyclicals. So it's just not commodities. When you talk about cyclicals, it starts with banks, real estate, commodities, and also the capital good plays, the capex plays. So there is a range of cyclicals which you have to talk about. So that is one, that you evaluate each segment of this cyclical on its own fundamentals. And like you mentioned about commodities, we can discuss about banks, or we can discuss about capital investment plays or capex plays. But I think the broader answer to your question also lies in the fact that what I think we are seeing is that there are genuine fears of inflation going up more in the developed markets, or the stimulus there has continued or has been disproportionate to the kind of economic impact one saw after COVID. So therefore, if that leads to a wave of inflation going up, even if it goes up gradually and puts upward pressure on yields, whether it actually results in higher yields or not is a secondary issue. If it puts upward pressure on the yields, and I'm all talking about global yields here, then obviously value and cyclicals tend to do better in that scenario as compared to growth. Because growth stocks are essentially like long duration stocks. So they are the most sensitive. Their valuations are the most sensitive to fluctuations in the global bond yields. I think there is a much bigger force at work. It is not just about commodities or banks. I think the debate is much larger, whether it's cyclicals as a whole, or whether it is back to growth and valuing growth at much higher valuations, which is what has worked in the last 4-5 years, if you see. That seems to have changed. I think the early indications are that phase might be getting over. Of course, things change in a very, very dynamic fashion. So we need to keep a close watch on what is happening on the global yields to really take a multi-year call on something like this.
Rahul, how are your thoughts on autos as a space? It completely got sidelined and ignored and snubbed for a while now. Numbers, obviously, dealerships were shut down, numbers were very weak, degrowth, inventories are piling up, very difficult to offload. And then on top of that, the margin pressure because of the commodity rise which you're talking about. In such a scenario, if one were to look at next 12 to 18 months, how would you analyze the prospects of the auto space?
So autos, again, like I mentioned earlier about cyclicals, it is not just one homogeneous sector. We have to see what happens in two-wheelers, how much is the disruption in electric vehicles, through electric vehicles in the two-wheeler sector. Then we have to look at entry-level cars, which I think are probably the safest place to be in right now in autos. Then we have to look at CVs and tractors. And I think in order of priority, one would look at CVs, tractors, and personal vehicles, which are passenger vehicles, as probably better than two-wheelers, given that the scale of disruption of electric vehicles is probably going to take longer. And also, and it's less visible right now as we speak. And also, I think some of the cyclical parts of autos, like commercial vehicles, and tractors has done well last year too. But in terms of commercial vehicles, we are seeing that if the investment cycle picks up, both in the public as well as the private sector, then we are coming off a very low point in cycle in CVs, and you could be entering into a positive CV cycle. Of course, a lot of things have to go right, which I said about investment cycle. But I think that is a segment which is worth watching. But as I said, each segment, we have to really look at it separately and not get carried away by autos as a generic theme, because each company, each segment is grappling with very, very different kind of issues and drivers for demand.
Fair point. Deep cyclical, out of all of them, actually is CVs, and CVs are, I was just looking at Ashok Leyland, and it's still way away from its all-time highs. But recently, even some of the auto ancillary companies which feed into the CV sector have started buzzing, so it is coming on people's radar for sure. There's also another space which is looking up, at least when we speak to a lot of companies' earnings, after their earnings, be it Indocount, textile exporters, Welspuns of the world, some chemical exporters, and auto ancillary exporters we also already spoke about. On this entire export-oriented theme, which could be a beneficiary of global rebound and US rebound in particular, many of these sectors actually are very small for funds to look at, but the bigger players over there are present in some of the fund schemes. How are you looking at this theme? And China Plus One as well included there?
Yeah, I think China Plus One is a very powerful. China Plus One is a novel term right now. I think what we are seeing today is that post-COVID, there is a genuine kind of demand for developing supply sources apart from China. It will not happen overnight because China has huge scale and therefore huge cost efficiency. Therefore, it will need subsidies for us to build the kind of scale which China has built over many years. And therefore, you see the PLI scheme, how it is targeted in terms of providing the right incentive to build large-scale investments, get large-scale investments and build large-scale manufacturing capacity, because scale will get you the further efficiency. So if you support these industries for 5 years, after that you will have scale, you will have downstream, upstream kind of investments into ancillaries and suppliers for these industries, and then automatically, the industry gets some kind of kind of gets into an autopilot mode in terms of getting the cost efficient. So I think it's early days. These are trends which play out for 5 to 10 years, like we have seen in China. The scales have been built over a period of many years. So what we are seeing is just the very beginning of that. Having said that, I think COVID has come as a kind of a godsend opportunity to accelerate that process. The process was already on, like I said, China plus one, but right now it's become much bigger than China plus one. And we are seeing that there is meeting of minds globally. And therefore, I think what India needs to do is to take advantage of that global consensus, which seems to be there around developing alternatives. So I think it's not just about chemicals or textiles, it's also about electronics, it's also about auto ancillaries. So as I said, I think some of these investments which you are seeing today, and also remember that when you have commodity boom like what we have seen in the last 1 year, it also will generate new capital investments. It will also generate new projects. There will be new announcements for projects. We've seen that in cement. We see that in metals soon. And therefore, you will have a multi-pronged kind of a pickup in the investment cycle, which has been lacking for many years, almost a decade in private capex. If you go back a decade, I don't see this kind of genuine drivers being present at any point of time. So I think it's in a nascent stage, the recovery for some of these sectors and the demand and the potential for some of these sectors. So we are quite we are quite excited by that as a segment. And these are comprising small segments. So this is not just one big sector. As I said, it's more spread out, more into mid and small cap segment also, and not just large cap.
Right, Rahul, we'll let you go on that one. Thanks so much for sharing your thoughts on different parts of the market, how they should be analyzed.